Hello, and welcome to our 2026 Investment Outlook webinar. Thanks a lot for joining our session. My name is Joe Little, and I am the Global Chief Strategist for HSBC Asset Management. And today we will be discussing our investment outlook, our scenario for the macroeconomy, the trends in global investment markets, and for private markets as well. Our outlook is called Role Reversal. And I'm delighted to be joined by our asset management senior leaders, Joanna Monroe, our CEO for Alternatives, and Xavier Baraton, our global CIO. Hi, Joanna, and hi, Xavier. Thanks a lot for taking the time to be with us today.
Hi, Joe. Thanks.
Hi, Joe. Thank you.
Right. We are live and we have our speakers ready. So we're ready to go. We're also standing by to answer your questions, and thank you for sharing those in advance of the session. Today, we'll get through as many as we possibly can. So let's get straight to it and explore our Investment Outlook 2026 with our key speakers. As I mentioned, this year's Investment Outlook is called Role Reversal. The main idea is that we stay with a modest risk-on exposure heading into the new year. We don't have a recession in the core scenario for next year, but we do have some stickiness in inflation, some modest interest rate cuts, and reduced policy uncertainty, which is an important part of the story. Now, that macro backdrop means that there are numerous examples where key asset classes have, or are maybe in the process of, changing characteristics and changing the part that they might play in our investment portfolios. So in risk asset classes, it means more broadening out, implying that laggard areas of stock markets, for example, can catch up in 2026. We think that's really important for emerging markets, especially. Whereas for some of the safety asset classes, the implication is that investors need to think a little bit more holistically around assets and strategies to build portfolio resilience, especially in today's highly complex macro situation. And this is what I've called diversify the diversifiers. So let's turn to our key speakers. Xavier, I'd like to ask you first, if I can, what does our theme of role reversal mean in your mind?
Well, thanks, Joe. As you probably know, in French, we say inversion des rôles works exactly or equally well as in English. It's the exact same meaning. So well done. A good phrase. Surely spot on. To me, this title sums up three things, really. First, this marks an important shift this year about the role that US assets play in portfolios. Some have quite decisively called it the end of US exceptionalism. I wouldn't go that far, but it's clear that many investors are revisiting assumptions about how much weight to place in bonds or stocks in the US. And for international investors, how much dollar currency risk to hedge. And these are new, really. Second, we've seen strong performance in international stocks and in emerging markets. We can see this really clearly on your chart, Joe. In 2025, clearly, outside of the US, a lot of that has been about repricing. So P's going higher or credit spreads moving to multi-decade lows, really. And it's also been about the dollar. So another role reversal is how those components of return might look a bit different in 2026, really. With valuations no longer being a tailwind, profits and even more so credit fundamentals need to stay good to deliver strong returns again in 2026, really. So the third thing, maybe one more for Joanna, really, and I'm sure she'll have a lot more to say about it. But it's been remarkable to me to see that many liquid alternatives like gold have performed very strongly. It's unusual to see, as you know, for stocks and gold to go up at the same time. I must say, the performance of gold has been very surprising to us, really. In the long run, it has tended to only match inflation. But it's a sign of the times, maybe reflecting uncertainty. And it maybe tells us that investors want to own private assets in preference to government assets, really. And Joanna, I'm sure you would echo that.
Yeah, thanks, Xavier. Thanks, Joe. Yeah, so I think a lot of what you've mentioned is also really relevant for investors in alternative asset classes. This idea that there is some fraying of the confidence in US assets, either because term premium rising in US bonds given the fiscal issues, or because the dollar is perhaps seen as a little bit less reliable as a safe harbor, or just because people are hedging a high concentration in the US. So these are important developments, and many investors are looking for bond substitutes. And that takes them to areas like hedge funds or infrastructure, and real assets are natural candidates for consideration. I mean, there's obviously been considerable volatility and turmoil in markets. And although that was more of a story in the first half of the year, I think it's worth emphasizing the point that alternative assets have different economic and different regional exposures and different investment time horizons. So at the long run end of that spectrum, you can have very long dated infrastructure projects, for example. So they offer ways for investors to manage that volatility challenge in investment markets. Now we've seen enormous interest from investors this year in private credit, and that's gone with strong performance. But more recently, there have been concerns raised there, and I know we're going to talk about that later. But other areas, like private equity, have ended up somewhat neglected, a bit unloved, in fact. So I think another version of your role reversal is that this theme of broadening out should encourage a further look at private equity and other areas like listed infrastructure, especially if we're getting some rate cuts. And I'd also bring in your line about diversify the diversifiers. Because for me, that is one of the reasons why democratization of alternative investments is so important for investors. I know that's another topic we're going to come back to. But let me ask you a question. I assume what you're saying about investment markets comes from some assumptions you're making about the economy?
Okay, thanks, Joanna. Yeah, you're right about that. As you know, we always say that expected returns, expected risks aren't static and fixed. They're contingent on how the economic environment is evolving and how asset prices are set. But nonetheless, I'll take the bait and I'd take the opportunity to share some of our economic assumptions for 2026. The next chart shows our scenario for growth, for inflation, and for policy, both monetary and fiscal policy in 2026. Few things to note from the chart. First, there is a coming together of growth rates across the Western economies. In 2025, we've had a pattern of what many economists have called the K-shaped economy. And what that means really is that leadership has been very narrow, coming from only a small number of parts of the US economy, similar pattern in markets, of course. But as we look ahead to 2026, it looks to us like the K is coming together a bit more in 2026. Tech investment is still going to be strong. It will add something like 0.5 percentage point to US growth. But the growth rates in GDP and profits across economies look more similar in the West. Now, within that, we expect European and Chinese policy to be delivered to support economic activity. But it looks to us like what will pan out is an important version of a role reversal in the macroeconomy. The US is going to be much less of a relative leader versus what we've seen in 2024 or in 2025. Still, the fastest GDP growth will be in Asia, in the Gulf, and in the frontier economies, especially in Africa. So we're looking at India, Indonesia as well. They're parts of frontier economies where the fastest GDP will be. No changes in this scenario from that perspective. But evidently, as we look ahead to 2026, there are some risks for emerging markets. And we might single out how quickly China is able to exit from deflation. So the policy side becomes important again. In terms of the global trade trends as well. And also ultimately, whether or not this promise of strong growth forecasts in emerging markets and in frontier economies is actually delivered. But critically, we don't have a recession in the core scenario for the world in 2026. Now, we have had some softening in short-term cyclical data during the fourth quarter. But we think that financial conditions and policy remain supportive as we head into the new year, and that really does help secure the growth outlook. A good example is the Fed cuts for 2026. We've got another few Fed cuts in our scenario, similar from the European central banks, the Bank of England or the European Central Bank, and cuts from policymakers, central bankers in emerging markets too. Although we suspect it will be more a case of emerging markets following the Fed in general. That's a role reversal again versus 2025, where we have seen in general emerging markets and European central banks leading the Fed. So a slight change there again. In Asia, some economies might even lag the Fed in terms of their cutting speed. And we suspect that certainly in parts of Asia, fiscal policy is likely to be really important. It will be a much milder drag on growth globally next year. Less tariff noise, less policy uncertainty, all of that helps too as well for the global picture. And some of the consequence of that, of course, is that the scenario on inflation also matters. You can see on the slide in the US, in the UK, and in some other economies like Australia, for example, inflation has got a bit stuck. So in some places, it looks to us as if 3% inflation is the new 2%. Now, that's less the case in the Eurozone, where inflation will be lower across Asia as well. But that's another important factor to bear in mind because it limits the number of policy cuts that we're likely to see in 2026. And it maybe reinforces this idea of the importance of fiscal policy and industrial policy as well, alongside just thinking about rate cuts when we put it all together and join the dots for our scenario around asset markets. And I should say a final point on this, when we look at the calendar of events coming up in 2026, it looks like it's going to be an important year for geopolitics. We've got the G7, Asia APEC, events in ASEAN, the US midterms later in 2026, of course, as well. So that new importance of geopolitical events is going to, again, be a feature of the macro system, key part of the story for investors today. And we're going to be tracking those trends very closely as we go through the year.
Thanks, Joe. So let's maybe first look at what this means for fixed income, if you agree, and then we can move into other asset classes. First, sticky inflation and modest rate cuts is an interesting backdrop, for sure. And one feature in bond markets that we've seen this year, most particularly, is steeper curves and a rising bond premium. It's very visible in this chart, looking at the behavior of long-term bonds in Fed cutting cycles. It reflects the backdrop of sticky inflation, but also fiscal risk and modest rate cuts. It has tended to steepen yield curves and keep bond yields elevated relative to previous Fed cutting cycles, really. So what does this mean for 2026? Simply said, the persistence of this backdrop suggests that yield curves will stay upward sloped, quite clearly. But it also means that long-term bonds might not be the reliable hedge that investors had become used to. It takes us to the idea of investors wanting to look for bond substitutes, as Joanna mentioned, and because we've moved from an environment of monetary dominance to one of what we might call fiscal dominance. Okay, it's never black and white, and I don't want to focus too much on labels here, but the point is that there is an important subtle change to the economic environment. One consequence of that is that credit spreads have fallen to multiple decade lows. Markets have performed, defaults have been low. Areas like data centers have supported the utility sector as well as tech, clearly. So logically, we hear from a lot of investors that high quality investment grade credits are seen as substitute for sovereign bonds, as an example, really. And we've even had some examples of credits trading through sovereign bonds. We've seen that in France, for example. And that's clearly an important role reversal. And of course, lower spreads and rate cuts, albeit in an environment where we don't anticipate a recession, which you underlined, impacts our assessment for asset returns and credit strategy too. Accordingly, we continue to prefer investment grade to high yield globally, but I think it's more important than ever to be doing detailed credit research with spread valuations where they are. It's an area for bottom-up credit specialists now, if I may say, Joe, no longer so much for top-down economists.
Okay, thanks a lot, Xavier. It's very clear. Joanna, do you think there is a case for bond substitutes in the alternative space as well?
Oh, absolutely. Absolutely there is. And I'd like to pick out hedge funds. I really like this chart from our investment outlook. So the chart shows hedge fund performance across the different decades. So you see the overall hedge fund index returns. That's the bar on the left for each time period, alongside some key strategies like global macro and multi-strategy. And what you can see is that the post-GFC period was a tough phase for hedge fund performance. And actually, hedge funds weren't particularly in demand from investors then because treasuries or gilts were really effective as a hedge. But if we go back a couple more decades to the 1990s, that was an environment where inflation was stickier. The world was a bit more multipolar, central bank roles a bit more limited, fiscal policy more active. Well, that was a really positive environment for hedge funds. So history tells us that an environment like that, and of course that's very much what we see today, is supportive for hedge fund strategies. And what's more, in a portfolio context, alternative diversifiers make a big difference to the outcome because the stock-bond correlation will tend to swing back to more historically normal levels. In terms of specific strategies, our team's currently focusing on discretionary macro, event-driven, and multi-strategy managers. So, Joe, it is really what you were saying earlier. This different economic environment means we need to find some different ways to get that resilience into our portfolios, diversify the diversifiers, which I find that a bit of a tongue twister, but you seem to say it very, very nicely.
Maybe some practice. Okay, thanks a lot, Joanna. Xavier also mentioned some of the trends in credit markets. Do you want to take the opportunity now to talk a bit about the private credit market and the strategies there as well?
Yeah, sure. So private credit, it's grown from what was really quite a niche asset class at the time of the GFC. Now it's more than a $3 trillion market. Performance has been strong, annual performance in the high single digits. We've seen rapid market growth and abundant liquidity. Now, that competition for deals has led to some reduction in spread, and that's very much connected to Xavier's comments on investment grade and high yield spreads. So while we think that returns will come down as interest rates are cut, in 2026, they're likely to remain above most investors' return thresholds. Now, there have been a number of headlines about stress in corners of the market. But the way to think about that is that private credit is not a single market. It's very broad, it's very varied, and it really matters which part of the market you invest in. Again, Xavier mentioned the importance of a quality focus. In particular, when we think about direct lending and the way we approach it, we focus on well-capitalized, recurring revenue, cash-generative businesses. The deals here, they're primarily bilateral, they're collateralized, held to maturity. So when you combine that with limited leverage and covenant-protected loans, these are very different investments from some of the situations that have been in the news recently. Now, although prioritizing quality hasn't always been rewarded, the fact that investors are becoming more discerning, that's a trend we see, that could actually be quite favorable for a more conservative approach. And in fact, tighter lending standards across private credit markets, that would be a welcome development. So we look at the slide, we can see that in these significant historical drawdowns, private credit, that's the bar on the left in red, acted as a portfolio dampener. So you can see that direct lending, it didn't only experience much smaller drawdowns during both the 2008 global financial crisis and the 2020 COVID pandemic sell-offs. It actually delivered a positive return during the 2022 inflation shock when most risk assets sold off.
Okay, great. Thanks a lot, Joanna. Maybe we should take the time now to turn to our other theme of broadening out. And you've both mentioned the tightening of credit spreads and the developments in credit markets. We've also got P/E ratios in the US at cycle highs and record high since the 1930s, concentration in stock markets, this time in mega cap technologies. So maybe, Xavier, we can explore with you what the broadening out theme really means.
Yeah, sure. Let me start on this one, really. As you mentioned, there does seem to be a coming together of profits growth across market next year. Tech has been almost 70% of US profits in 2025. And in market cap terms, as you know, we are seeing record highs in terms of concentration. It's been tech versus the rest, to cut it short, really. And profits forecast for next year show this coming together. If that's right, and we get the macro backdrop you described earlier, then there is a case again for broadening out of performance into areas of markets that have lagged, really. I'm not saying that there is not a hugely important shift with AI. Obviously, there is. As you mentioned, it's boosting our growth assumption for the US again next year. But there are some big questions as well around mega cap tech valuations now, and there are some big questions around the ROI on the capex spend, as well as the circularity of financing we've observed. The broadening out ID reflects that the opportunities in the global technology sector, in Asia, China, or India tech, for example, could be just as profitable and with less valuation risk for investors. Broadening out also means to us how the investment boom can spill over into other sectors. We can mention utilities, construction, healthcare, basic materials, and so on, really, and lift up the performance of some of those other sectors. So market dynamics become less about tech, and other stock market weighting schemes, equal weight, or the S&P 493 have a chance to perform as well. And it's really interesting to me that US stocks outside the tech sector, or EFI and NEM stocks, remain at wide valuation discounts. It's very, very visible. By itself, that's never a guarantee of success, but it does emphasize that these assets have room to run. You mentioned at the start, Joe, that China and Europe have re-rated a lot in 2025, and I'd like to finish on that. That's certainly true, but you also have to remember that prior to that, there was a decade-long process of underperformance versus the US. So in other words, it could be that we are at a turning point. Maybe, Joanna, you would like to...
Yeah, thank you. So yes, there are several alternatives areas that seem well positioned for that broadening out theme. The first that come to mind are real assets and listed infrastructure. So listed infrastructure being investments that own or operate essential infrastructure, things like power and transport. And their dividend yields seem high, particularly given these are investments that align with some of the key growth themes you've mentioned, AI and the energy transition. And then in real estate, with AI's appetite for power generation, the rise of e-commerce and data sovereignty concerns, the global rollout of data centers is another important growth area. But even more interesting is what we call the living sector. That includes multifamily and single-family rental, student housing, and senior housing. There you have attractive fundamentals. You've got rising urbanization and limited supply, and aging demographics are driving this demand for senior housing. So this is a sector with stable cash flows, high occupancy, regular rent reversion, and in that context, we'd look particularly at Asia. And then if I could put private equity into the mix, the exit backlog seems to be easing up gradually, with activity picking up slightly in the third quarter. So total exit value for 2025 is already well ahead of 2024 levels. We've had a number of mega exits. So more assets are already moving through the system. And there are a number of factors supporting a more prolonged recovery in exits and distributions. Modest Fed rate cuts, an easing on tariff uncertainty, better M&A and IPO activity, as well as the growth in the secondaries market. So that's a number of themes within the alternative space that I think fit quite well into your macro broadening out theme.
Okay, thanks, Joanna. So it seems, listening to what you say, is a similar idea in the arena of the alternatives markets. For the investment outlook, we're looking at the opportunity for some of the laggards to become the leaders. And the reason that the broadening out is happening, or is permissioned to happen, is connected to the macroeconomic assumptions that we're making in the recession scenario, the coming together of growth. And also in the market's context, a reaction to the fact that some parts of the market are being more widely recognized by investors as somewhat frothy, and maybe then with the risk of future disappointment around returns. Brilliant. Thank you both for the great answers so far. The final area to touch on then, before we go into the questions that we've received, is to think about Asia and emerging markets. The big question that we deal with in the investment outlook is the extent to which emerging markets have been lucky, or have they been good? They're lucky because of the weaker dollar boosting up performance, or good because of macro reforms, more developed financial markets, and all of that having an effect on de-risking emerging markets for investors. Xavier, what do you think about this first?
Well, thanks, Joe. Definitely an interesting framing, but as always, it's a bit of both, really. A weaker dollar has surely helped performance in emerging markets. This is another chart from our outlook, which sums up the picture. It's quite remarkable how the weaker dollar influences the situation in emerging markets. We know that it loosens financial conditions for EMs. It encourages capital to flow downhill. Now, there are some challenges for emerging markets in 2026. We should look at them. Really. What are they? Firstly, China is still challenged by deflation. We have the longest stretch of deflation readings in China since the Asia financial crisis. So we are looking for policy support and maybe some of the fiscal measures emphasizing consumption from the recent 5-year plan to help with that. Secondly, we also have trade risks. Obviously, tariffs have dropped off the radar for investors a bit recently. And we've seen more of regionalization in Asia trade flows, for example. But 2026 will be a busy year for geopolitics again, so we'll need to watch that fairly closely. Finally, investors will want to see that those strong growth rates you talked about at the start, Joe, are being delivered too. But it's not just about lingering risks, wouldn't be fair. There has also been some macro de-risking, and it's created quite an amazing result of EM asset classes, showing lower volatility than developed markets. Very striking to us.
Yeah, that's great. Thanks, Xavier. I really like that chart too. Incredibly powerful visual. Joanna, some final comments on the key opportunities in Asia and emerging markets from the perspectives of an alternatives investor?
Sure, yeah, thanks, Joe. Well, I think the Asia theme is relevant for a lot of what we've discussed already today, but perhaps it's worth highlighting two areas, infrastructure and private credit. So in renewable energy, the Asian region is a key player, both as a consumer and a rapidly growing producer. So the APAC infrastructure market reached a value of $1.61 trillion in 2025, and it's projected to reach 2.22 trillion by 2030. And some of the strongest returns here have actually come from the mid-market, because there the infrastructure projects, they tend to be smaller and less prone to cost overruns and delays. We've also seen that after a period of very strong performance from the US infrastructure-related sectors, on a relative basis, valuations are now more attractive in China. And then my second would be private credit. So for investors looking for growth, looking for diversification away from US and European markets, Asia private credit, that's a very natural area to allocate to. It's a sector that's growing rapidly now. Demand is being fueled by major investments in regional infrastructure, things like smart cities, renewable energy, but also increased intra-Asian investment. And we're seeing growing demand for flexible bilateral credit solutions. That's to meet corporate financing needs and increasing private equity ownership. So Asia private credit, in the right part of the quality spectrum, Asia private credit offers investors the potential for attractive yields with low default rates and increasingly institutional deal structures.
Wonderful. Thanks a lot, Joanna, and thanks a lot, to Xavier too. I think that was a great tour around some of the main asset classes, main strategies, and how they connect back to our investment outlook themes. Let me replay. I've made some notes as you've been speaking, so hopefully it's a good replay of what you've said. We see the role reversals in how asset markets are set to behave looking ahead to 2026. Xavier also talks about how this can play out in terms of the drivers of returns in 2026 as well. It's an interesting perspective. Our macro trends point to a broadening out of market performance. That means that laggard sectors, laggard themes have the potential to catch up in 2026 if that sort of economic scenario is delivered. And that's especially important for emerging markets, given the points that Xavier mentioned, but also under our expectation of a weaker dollar next year. And then finally, we have the theme of diversify the diversifiers, our tongue twister, which reflects on the importance of adding new asset classes and new strategies into the mix in what is a really complex economic situation today. Right, we're going to move on to the next section of our webinar. We've got a little bit of time for some questions and to address some feedbacks that we have received. We've had a lot of questions through. I'll try and get through as many of them as I can, and I'll take the liberty of posing the first one to Xavier, if I may. Xavier, it's a bit of a macro question that comes through first, in terms of what the scenario looks like under the alternative view of a bigger artificial intelligence investment boom. How would that play out for investment markets, do you think? And maybe we can bring Joanna in as well on that one.
Sure, absolutely. I mean, it's definitely a key alternative scenario in a lot of investors' minds, really. And obviously, the fiscal impulse and tax deduction has translated or contributed to some form of crowding in of investment in capex related to AI, also influencing other sectors, as we said, really. And this AI mega trend, as a result, is much broader than just the Max 7 now. It encompasses a lot of other names, and with some ripple effect favorably on Asia Tech utilities. So it comes with certain risk, but it also prolongs the US exceptionalism theme or scenario very positively. It supports the dollar. It implies to be also more selective on the rest of the world, IFI and EM exposure, with the US prominence being extended further to a certain extent. So PE exposures could be also more aligned to AI and digitalization. The ones more aligned to digitalization could fare better. But I think, Joanna, I'm sure you would want to second that and add to it.
Yeah, I mean, obviously, it depends where you're investing on the PE side, and again, that's definitely a theme that we've seen growing interest in. The other thing I'd highlight is, we mentioned that renewable energy, and part of the drive with renewable energy is the hunger of AI for energy. So I think if we have a bigger AI boom, I think that will also have a positive impact in terms of the demand for renewable energy and the investments there.
Yeah, that's a very good point, how those themes are percolating and cascading through the rest of the system, and then the knock-on effects that they might have is a really good way of looking at it. Okay, Joanna, we've got you warmed up on the questions. So maybe there's a good one that's come through. In fact, there's two specific ones on alternatives that have come through on the feedbacks. Firstly, around the democratization of alternatives, and also maybe we'll group it together. What can be the hot alternative themes for 2026? What's going to be hot next year?
Okay. So the democratization, I think it's really important that people see the context here. So at the moment, individual investors hold around 50% of global assets under management, but they only hold 16% of alternative investment fund assets. So given what we've said about the value of alternatives in creating resilient portfolios, that's a big gap. Now, private wealth investors are increasingly having the option of investing through open-ended or evergreen funds. They'll tend to offer lower investment minimums than the conventional closed-ended. They have this periodic liquidity, and they also offer a more straightforward investing experience. There are different regulatory frameworks supporting the adoption of these more widely, and we think they're a really interesting development. The important thing there is that investors obviously have to understand open-ended is not the same as liquid. And also the selection of funds here, you have to think about it in a very diversified way. And it's really important to focus on high quality managers who are really have a very robust approach to their liquidity management. So that would be sort of the general sort of democratization. In terms of hot, we don't like to use the word hot, Joe. What do I think are the interesting alternative themes next year? So definitely, PE coming back into favor. Private credit, and we mentioned Asia, but also the right parts of the quality spectrum and private credit in Europe. And then I come back again to hedge funds. I think hedge funds are this really important sort of substitute asset class, if you like, in this environment that we're in now. And they really do enhance the sort of resilience of an investor portfolio.
Yeah, great points. And those themes come through really loud and clear in our investment outlook and killer charts on some of those topics that our colleagues across the investment team have been working on. Okay, we'll give you a short breather, Joanna, and go back to questions for Xavier. Xavier, a couple of ones more macro markets coming on the list. Firstly, around the sensitivity of some of our market assumptions to a rising dollar. Worry about a rising dollar scenario. We've said that our core assumption is the dollar will weaken in 2026, but do you worry about a stronger dollar, and how might that play out as a scenario, do you think?
Well, maybe first taking a step back, Joe, and analyzing what context would favor the US dollar. And I think it's important to have that in mind because it obviously points at the higher inflation, higher growth scenario. Also, confidence in productivity, higher R-star could also encourage higher rates in time, and finally leading to a slightly more conservative Federal Reserve rate. So a scenario which hints at the upper end of our scenario distribution, an acceleration, which obviously would shift the spotlight back again onto US dollar assets, generally speaking, as a result of an accelerating economy. And I think with benefiting also the alternative sphere through, which is largely around or revolving around US dollar assets as well in private debt, private equity, hedge funds. So I think it's investors would have to continue to hang with the US dollar sphere, US risky assets, generally speaking, and continue to believe in relatively compressed risk premiums and term premiums.
Okay, I'm being told we've got time for two more questions. So there's a good one, Joanna, on hedge funds that have come through, given the point that you raised around how critical and important that theme is. Could you talk a little bit about some of the strategies that you think are interesting around the approach to hedge funds, which might be what you would focus on at this point in time? You and the team have got a lot of experience managing hedge fund strategies over many years. So some lessons or as all.
Sure. So it's always worth saying it again. Hedge funds are central to our alternatives proposition. It was the first asset class, we were involved in on the alternative side way back. So it's definitely worth emphasizing some of what's made the difference here. And I think we've talked about this in previous outlooks, but there's this dispersion, this very significant dispersion of returns between top and bottom performing managers. So in the hedge fund world, manager selection is absolutely key alongside strategy selection and the appropriate rotation. And in terms of how we do that, it's not just about being smart about the investment strategy. It's not just about the portfolio management team's skill and timing. It's also about the infrastructure side of things. So when our fund of funds team are looking at hedge fund strategies and looking at hedge fund firms, as well as everything you'd expect to see in terms of investment process due diligence, just as important for us is the operational due diligence. And in that, what I mean is we're looking at aspects like who are the service providers, we're looking at the approach to risk management, looking at the approach to valuation. And in our more than 30 years of working with hedge fund managers, is that comprehensive approach that's helped us consistently identify the managers that meet our standards and deliver for our investors.
Great. Thanks a lot, Joanna, for the detail. We are running out of time. Maybe I can ask you both just in a few words to sum up your key conclusion on the investment outlook. Xavier, could you go first, just in a few words, summing things up?
Well, I think the AI music is certainly encouraging investors to continue to allocate to risky assets. And it's a key message we delivered, really. You need to continue to be invested. But at the same time, it comes with increasing, mounting risk, really. And the returns are bought over the future now, quite clearly. Economies need to deliver the fundamentals and the quality. So it clearly calls for greater selectivity on whether it regards U.S. credit, equity, stocks, and as Joanna underlined, alternatives as well, really. It will be a lot more bottom-up than it was in 2025, I expect, really. Possibly with more volatility as well, really.
Joanna, you get the final word. Joanna, a few words. How would you sum it up from the
Well, of course,
alternative
you're going to expect me to say this. It's going to be a really interesting environment, and it's going to be some great opportunities for alternative assets, provided you think about the right alternative assets and provided you bring them into a diversified portfolio, then you'll get all the benefit of their resilience and their return opportunities. Thank you.
Great. We got it. Thanks a lot. Okay, so we have run out of time. I'm sad to say, time flies when you are having fun. Thank you to our speakers, Xavier Baraton and Joanna Monroe. Thanks to the team behind the scenes for all of the help. And thank you for joining us in this deep dive webinar to celebrate, but also discuss our investment outlook for 2026. I hope you found it useful. I hope you heard some of the questions or ideas, feedbacks you had were being answered during the course of the discussion today. And you can find all of the extra detail and notes, all of our content, videos, and slides available on our investment outlook microsites on our main website. We'll make sure the link is available to you, however you normally access that. So thanks again for joining our session today, and I see you next time when we can speak again about the investment outlook and future trends in investment markets. For now, goodbye.